So for me, the really interesting one, and I think my favorite from this survey, was actually the oil price expectations for next year. It was the second question. Our first question was about oil prices at the end of this year, and second question was about prices at the end of next year. And it's just interesting that the sentiment has actually quite changed, tilting quite bearish in this question, which I thought was interesting. So back in March, when we asked the same question, it was only just more than 50% of the respondents that said Brent oil will be below $70 a barrel. This time around, it was 80%.
I would kind of echo what Sally just mentioned in terms of the bearish sentiment. I think that translates to European gas as well. And the question that got my attention the most was if most respondents see an oversupply of gas in Europe into next year, and nearly 60% of respondents believe that we are marching into a gas supply glut in Europe.
I think my favorite question was one related to data centers, and perhaps it provides a little bit of medium-term boost to how you could think about the demand outlook for gas. So we asked which fuel is best positioned to help meet the rapidly growing demands from AI data centers. And I think quite interestingly, about 72 respondents pointed towards gas, either as a standalone option, about 36% of the respondents, or we also gave the option of saying a strategic mix of gas, solar, other fuels, and that also got 36%. So I think it's quite clear that gas is going to be an important fuel in that story. Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got Salih Ilmaz joining from his usual perch over in Dubai. Welcome back to your home there, Salih. And then swinging over to Madrid, we've got Patricio Alvarez joining. Today, we're going to cover the results from our recent client survey. Many of you listening will have participated in that. I want to thank you for taking the time to let us know what you think about the markets. And so to kick off the conversation, I think the best way to do it would be to sort of ping everyone here on the call and get your take on which question do you think had the most interesting response, and then we'll make an effort to go through all 30 questions and kind of discuss here with the group. So Salih, let's come over to you. As you look across the questions we asked, what really strikes a chord with you? Which one do you find most interesting?
Sure. Thank you, Rob. And I'll just very quickly echo what you said. Huge thank you to everybody who participated. I'm sure a lot of people among the listeners here today did take the time to fill the survey. It was a little bit longer than usual, but we appreciate that you all participated. And I mean, I love these surveys. I've said it before. I think every single question is very interesting, and the results are very valuable in kind of seeing where the sentiment might be on each topic. So for me, the really interesting one, and I think my favorite from this survey, was actually the oil price expectations for next year. It was the second question. Our first question was about oil prices at the end of this year, and second question was about prices at the end of next year. And it's just interesting that the sentiment has actually quite changed, tilting quite bearish in this question, which I thought was interesting. So back in March, when we asked the same question, it was only just more than 50% of the respondents that said Brent oil will be below $70 a barrel. This time around, it was 80%. And perhaps also interestingly, so that's on the upside. Very interestingly, none of the respondents said they expect oil prices, Brent oil price, to be below $50 a barrel at the end of 2026. So the downside is capped and upside is limited. Is my takeaway from this. So we will be kind of, I mean, the prices have been rather range bound. It sounds like the expectation by the market participants is that we will be in this $50 to $70 a barrel range very likely in 2026.
Okay, thank you for that, Solly. Very interesting. Patricio, let's come over to you. Let's get your read. What was the most interesting question in your neck of the woods? Are clients also feeling a bit more bearish here at the moment?
Sure. Yeah, I would kind of echo what Sally just mentioned in terms of the bearish sentiment. I think that translates to European gas as well. And the question that got my attention the most was if most respondents see an oversupply of gas in Europe into next year, and nearly 60% of respondents believe that we are marching into a gas supply glut in Europe next year. And what's interesting is that we also gave out a question about prices. So most respondents actually think that gas prices are going to remain range bound where they are now, so 31 to 35 euros per megawatt hour. Although 60% of them, which is a big contrast, believe that we are walking into a supply glut. So that seems to be somewhat of a dissonance there. If most are expecting a glut, I would expect prices to come off where they are now. So roughly they're trading at 32 euros a megawatt hour now. And I think if we look at the potential upside risks for European gas, I think those are sort of melting away. Now that we are with storage levels at almost 83%, it looks like we'll exit October close to 90, maybe 87 to 90% full, which is lower than last year, but again, it's very adequate and it's very in line with the longer term norm. So I would say storage concerns are easing. In terms of the upside risks, I think it's only a matter of potential sanctions for Russian LNG, which continues to contribute about 5% of European demand, and any sort of ceasefire or change in the conflict in Ukraine could also have implications for Russian flows, either coming back. Because if we all remember from the start of this year, Russian flows via Ukraine were halted. So any ceasefire agreement there could either mean that some of those flows could come back, or any other change in the geopolitical landscape could mean that we actually stop receiving those. So I would see that as the only sort of vector of upside pressure. Otherwise, demand in Europe is unlikely to rebound much into next year.
Fantastic. And while we're on the topic of gas, I'll highlight that I think my favorite question was one related to data centers, and perhaps it provides a little bit of medium-term boost to how you could think about the demand outlook for gas. So we asked which fuel is best positioned to help meet the rapidly growing demands from AI data centers. And I think quite interestingly, about 72 respondents pointed towards gas, either as a standalone option, about 36% of the respondents, or we also gave the option of saying a strategic mix of gas, solar, other fuels. And that also got 36%. So I think it's quite clear that gas is going to be an important fuel in that story. And I think there's a lot of anecdotal evidence to support that, but it is interesting because it runs counter to the proclaimed ESG goals of all the hyperscalers. Every single one of them has a desire to have net zero emissions, so gas in their power mix, would sort of run afoul of those goals. And as a result, you actually see a number of the hyperscalers talking about nuclear and other technologies. And we did ask some questions on that are pretty interesting, but we'll circle back around on them. We'll hold the punchline there on that. But I wouldn't be too optimistic on at least nuclear within this decade of the role it could play. And I think the results that we saw do confirm that. So let's swing back around and zoom out for the survey, because we did ask questions that I think kind of can be bucketed around various topics. So Sally, you already talked about the oil price expectations. I know we asked for end of 2025 and 2026, but I'm wondering if you can frame, because you've already talked about the price story, but we asked a number of questions about sort of what are the drivers, whether it's geopolitics or demand factors. But can you give us a sense, what's comes out of the survey results from a fundamentals perspective, in your view, that feeds into that bearish narrative that folks seem to have embraced?
Yeah, sure. And I thought this was also an interesting result in the way that more people now think OPEC plus policy is a more important driver for oil prices than the demand growth and the China story. And this is also interesting because it has changed from the result that we saw back in March. So now 38% of the respondents said that OPEC plus policy is going to be the key driver over the next 12 months. And that's up from 25% in March. And back in March, it was actually the China story, the demand story, that was the key driver picked by the majority of the respondents. And that was 40% of the respondents back in March fell to about 20% this time around. So I thought that's quite interesting. And to your point, I guess that could explain why there is at least partly explain why there is a bearish tilt now, because if OPEC plus policy and strategy is a key driver, we know that their strategy has moved more bearish in the way that they did the jumbo hikes. At least they promised to do the jumbo hikes. And even in the last meeting, they didn't pause, and they have announced more output hikes, not as big as the last few months, but for the rest of the year, they will keep bringing marginal increase in their supply into the market. So I thought that was quite interesting. On the pricing, there was another question that I thought was interesting that I'll mention very briefly. Geopolitical risk premium is something that we talk about quite often, and I do usually mention how difficult it is to actually try to gauge what the geopolitical risk premium might be, and it's a bit of a moving target as well. But we did have a question on where and how much of a geopolitical risk premium people think there is, and it's still a similar picture in the way that 77% said that the risk premium today is negligible or very low, and about 24% said it's moderate, and no one said it's very high, which is not very surprising. It's pretty much in line with what we saw back in March, and it's pretty much in line with our current view on the premium. And yeah, I mean, a lot of interesting results on OPEC as well, but maybe I'll stop here and then we can revisit OPEC later on the call.
Yeah, well, I'm curious, just to follow up. I'm always curious as to how much influence OPEC can really have on the market, and it does seem that I like the fact that there's the ebb and flow. Give us a sense, how much of the supply mix does OPEC currently control, and how does it square with what's been happening from U.S. shale production? Is basically the idea, in your view, that OPEC is taking the reins over the next 12 months from U.S. shale producers in terms of the marginal barrel in the market?
I mean, it's a good question. OPEC's market share has definitely, shrunk over the last couple of decades. Now, when we look at core OPEC producers, that's less than 30%. But now they have combined with some of the non-OPEC, non-core OPEC producers, and now they are a bigger group called OPEC Plus. I think together they hold, I think, a little less than 50% of global supply. So it's obviously significant, and I think it can move the market in the sense that, they have been quite intentional with how they intentionally kept some of the supply away, and now they have a certain strategy of bringing that supply back. So they are kind of the swing producer still in the way that they are trying to manage the market. But again, I mean, you can't rule out how reactive and how quickly reactive US shale can be. So I wouldn't rule out, what happens with US shale also driving oil prices. But I think one of the reasons why a lot of people might have picked OPEC Plus policy is because of how the group is meeting every month. They have been very agile in the way that they can change what they do with their supply policy. So I think in that way, I think a lot of people think that, by either keeping their current strategy of bringing more and more supply or switching, they can actually, change the course of prices. And, maybe you can argue that they're not, I mean, OPEC Plus does not, or OPEC does not have as much force in the oil market as it used to, maybe back in 90s, but it clearly still has some influence on prices, and that's what the sentiment seems to think as well.
Maybe just to follow up, in your overview of the survey, you mentioned President Donald Trump and his I think he's multiple repeated calls for oil in the $50 a barrel range. I'm curious how you think that might be influencing the market and frame it versus OPEC. And I will note you also asked an interesting question, I thought, on the price level that would effectively start to destroy demand. So frame Trump versus OPEC for us, but also talk a little bit about what the survey tells us on the sort of demand picture. Where do prices have to be to see any meaningful demand knock?
Yes. So first on Trump, there definitely seems to be consensus on the view that Trump will most probably be bearish for prices. This is in line. I mean, this is a question that we asked previously as well. So still more than 50% think that Trump's policies will be bearish for oil prices. Interestingly, the response of no impact has grown since March, but still more than 50% think it is Trump's policies will be bearish, and many respondents do think that either moderately or aggressively Trump will be pushing for $50 a barrel in the rest of his term. And this is in line with some of the rhetoric that we heard from the administration repeatedly. And this is something that we've written on before on what it might mean, and we are actually working on a longer report on what that might mean for energy companies across the globe. But definitely, I think to your point, that bearish tilt, I think, is at least partly driven by Trump and his policies, which is in line with our view as well. So I'm just trying to pull up on the demand one. I just know that we didn't really have a clear consensus on where respondents think there might be demand destruction, like which level does oil need to go up to before we see demand destruction. So I'm just looking at the results now. quite a few think, I think about 50% think it would be less than 90. It would be around $90 a barrel, but I mean, still about a third think prices in 100 in triple digits would still be acceptable and wouldn't result in a lot of demand destruction. So not a clear consensus there, which is perhaps not too surprising, because I mean, if you ask me this question as well, it's not there isn't an easy answer. And even looking at the recent past, the 2022 period, we didn't really see a massive demand destruction, I don't think, even when we were at prices about $100 a barrel. So it's not an easy question. Perhaps I was hoping that we get a consensus that would help us with our view as well, but it is very widely distributed in terms of where people think there would be demand destruction for oil. Yeah.
Right. So I have to say, one of the listeners asked what the book behind me was. It's the World Energy Outlook from 2010, and I'm actually going to flip it open to one of the figures. I'll share this better screen grab of it. This is projected oil demand back in 2010, and they did have a scenario where global oil demand peaked. It looks like around 2019. So looks like we're not in that world, I suppose. And always very interesting to go back and look through old projections, to help calibrate maybe how you think about the future. And so with that in mind, Sally, we actually have probably for more than 5 years. I think I recall it from 2017, 2018. We started asking in this survey that we do periodically, when do you think oil demand is going to peak? Can you walk us through where we're at on that today, and maybe frame it against any recollection you have on how that's changed over the years we've been doing this?
Sure. And when you asked about my favorite question, this was a close second, because it's always very interesting to see what people say on peak oil demand, not because we think somebody would magically know, but mainly because it's very fascinating to see how that sentiment shifts as well. And it's a long-term question, so nobody obviously knows, but it's interesting to see. So 45% still said that it's going to be that the peak will happen between 2030 and 2040. And perhaps more interestingly, 21% said, only 21% said oil demand will peak before 2030. And to compare that to some of the previous results that we saw, so that's 21% now. In 2024, last year, it was 38%. And in 2022, it was 50%. And I don't have it in front of me right now, but during the pandemic, it was even higher. And just before the pandemic, it was much lower. So to your question, I think it's been interesting, before the pandemic and the pandemic shock to demand, I think there was a lot more confidence in continued oil demand growth. And then we had the pandemic, and during this period, it was very clear for us to see the shift in sentiment where, I think a lot more people got concerned about the future of oil demand growth. And then since then, we can now see that shift back into more and more people thinking oil demand will continue growing at least through 2030. So fascinating, I think. And again, I mean, IEA doesn't know. We don't know. Nobody really knows. But it's interesting to see how the sentiment is shifting. And one thing I would also note, and perhaps we'll find a way to ask this in future surveys, is when we talk about oil demand peaking, but oil demand is not necessarily going to peak and then fall off a cliff. It's very much possible that it peaks and remains at that level or at a very high level for a prolonged period of time. Maybe, so I think that's sometimes lost in translation for some people, but but it is. I'll try to see if we can squeeze that into a future survey.
Fantastic. I just will observe. It's been interesting to watch the conversation over the course of my career, and in some sense, where have all the peakists gone is quite interesting to think about. And I would even say, at the start of my career, uh, I'm middle age, I suppose. So, over 20 years ago, in the early 2000s, there was a lot of conversation about peak supply. So if you think back to '05, Matt Simmons wrote an interesting book called Twilight in the Desert. So we went from this idea of peak supply to peak demand as early as the 2010s and the IA Annual Energy Outlook, and it's just interesting that the conversation just seems to keep getting pushed out and pushed out. And so, Patricio, Sally, we're going to come back to you because I know you've got some more oil-focused questions, but I want to get Pat back into the conversation. And so, Patricio, I think there are a number of questions that we asked related to the energy transition. And so a couple things come to mind. There's this narrative that we've heard for a long time about gas as a bridge fuel and an important fuel in the energy transition. But I will note, last week when we were having a very utilities focused discussion with Nikki and Gabriella, your counterparts here in the US, Nikki posited this idea that actually renewables are the bridge fuel to gas because you can build them more quickly right now, and that nuclear might also be a sort of coming fuel. So it's basically renewables now, then gas, then nuclear is kind of the framing she laid out. But I'm curious, when you sort of look across this survey, what are you seeing on the energy transition front, and how are you thinking about gas's role in it?
Sure, I'll try to frame it against Nikki's comments, and I would say perhaps the survey results contest the idea that renewables are the bridge instead of gas. I think the consensus is first and foremost that SMRs or new forms of nuclear generation won't be ready until next decade. I was surprised to see some of the results in that a lot of the respondents actually were quite positive quite positive on the startup of SMRs. Most of them think it will happen in the early 2030s. I'm a bit more skeptical than that, given that even the most advanced designs will be just ready for regulatory approval by 2030, and these are first of a kind designs. And if we look at the track record of large scale nuclear reactors, it's a very poor track record. So even with proven technologies, we're struggling to deliver a reactor in within a decade, and below somewhere about 10 million per megawatt. So it's pretty expensive. And if we think about the energy transition, or at least the way that we try to think about it from the utilities perspective, is that utilities will tend to invest in the technologies that give the higher margins, that provide the higher margins. And I know people sometimes question the validity of the LCOE metric, which is the levelized cost of energy. But at least in Europe, if you think about the input costs for generation, if you use gas, at least in Europe, you're paying a premium. You're paying almost 3 times what Henry Hub is. You're paying here in Europe to burn gas for power. And on top of that, you will have to pay a carbon allowance cost. So the economics of gas-fired power in Europe are poor. They're very weak when you compare it to solar and wind, which have almost zero variable costs. So from that perspective, I think utilities will continue to invest in renewables, not necessarily as a bridge fuel, because I think, like you mentioned, a lot of the tech companies investing heavily in the deployment of data centers. They do have very stringent and ambitious climate goals, and I know there's some rhetoric talking about how they are giving up on them, or they might postpone them. But to that point, it's possible that they're trying to pair, and this is empirical evidence. We know that there's a few large sites that are using this combination of battery storage, solar, and gas. And the gas part of it, you use it for peakers, like for peak demand, and that's how you try and provide 24/7 baseload supply due to the lack of nuclear. So I'm not trying to contradict Nikki at all. It's just like by the time we get to when new nuclear will come and be commercially available, which can be a great source. Like let's remember that data centers are only a small part of the incremental electricity demand that will come to materialize over the next few years. So maybe nuclear will be late, a bit too late for the pace needed for data centers. And I think the surveys, at least the gas part, people are pretty positive about the size of the role of gas in this deployment. So that perhaps I would side with the thesis that gas remains a transition fuel. And it's funny because it's been the transition fuel for so long that I don't know if we should keep calling it a transition fuel.
Yeah, I not to dwell too much on early start of my career, but over 20 years ago, I worked on a paper with some colleagues talking about a nuclear renaissance. And the rationale was completely different. Shale gas hadn't been discovered, and the basic idea was that the U.S. was going to be a net LNG importer, not an exporter, and that nuclear would sort of work in that world. But that version of the Renaissance didn't materialize. So I guess I have from learned experience, I have some skepticism about nuclear as well. Maybe just one more thing from me that I think dovetails with what you just said is we did ask about the share of capacity additions in the U.S. in 2026 through 2028 that will come from renewables. And so, or actually, no, we didn't. It wasn't renewables. We actually solar plus battery storage. And so I think this year it's going to be around 80%. And 55% of the respondents expect that it will remain above 70% in 2026 through 2028. So despite the big pullback in policy support, despite the change in rhetoric, I think the vision that most of you would have is that solar in particular, but sort of generally renewables, they're not going away, and that we're going to continue to see a lot of deployment of that type of resource, particularly in the US, over the next few years. So let's keep an eye on that space. And Sally, while we're talking energy transition generally here, I want to swing back around to you because you did ask some questions not related to the oil demand construct, but you asked about sort of how ESG could be featuring in the strategy of the oil majors. So for years, we saw ESG really become a prominent talking point, an idea, whether it's BP or others, in terms of how the oil companies are thinking about their future. And I do get the sense that a lot of that has sort of paused and rolled back. But tell us what the survey indicates on this kind of question as well.
Yes, sure. I thought that was quite interesting as well. And we call it perhaps like ESG fading in a way, because now 56% of the 92 respondents to the survey said ESG influence on oil company strategies will be minimal by 2035, and 57% said that current transition policies will have either little or no impact on oil demand. And perhaps related to this, I thought, we had a question on investment into upstream, investment into oil exploration and production, and 50% said that they expect moderate or significant increase in E&P investment over 5 years, and only 25% see declining investment. And I think this is also in line with some of the messaging we've been hearing from the IEA, where at some point, I think there were some scenarios where they were saying that there may not be a need for much more upstream investment, but I think those scenarios are being revised now, and I think the expectation is now that there will be a need for continued significant investment in oil and gas, simply to keep the current production level, let alone grow upstream. So that is in line with the results that we saw, and yeah, I thought those two were interesting and related.
Solid. We do have a question in the chat from one of our clients listening, and I know we don't have the answer broken out in this way, but I'll ask it for you to give some color here. So, can you give us a sense on how this ESG construct is differentiated by region? You know, how does it look over in the Middle East where you sit versus Europe versus America? Any color you can provide there would be great.
I mean, good question. We didn't really break it down in the survey, but I think it's a very good question nonetheless. The way I would look at it when it comes to kind of oil company strategies is that we know a lot of the European majors or some of the middle sized integrateds in Europe have been a leader in the way that they've been perhaps taking ESG a little bit more seriously, which was reflected in their strategies, in their climate targets, in their capex spending and the breakdown in their capex spending, because they were earlier than a lot of their global peers in starting to divert spending away from the legacy businesses into ESG. And then, you know, like we've highlighted this many times in the last few years, that could be one of the reasons for a relative discount in their valuation when you look at some of the European majors, some of these European oil companies, compared to their US peers and compared to Saudi Aramco, which you could see as a proxy of the Middle Eastern national oil companies. And, you know, that might just be investors looking at, you know, what that shift might mean, and they might just look at lower expected returns from some of these new spending compared to their conventional oil and gas projects, and then discounting those, and you know, and ending with a lower valuation for those companies compared to US and Middle Eastern peers. So that's kind of the angle that I usually look at this at.
Fantastic. So just a quick bit of marketing here. So if you haven't seen it, Scott Levine from the team, he's a regular on this call. He put out a deep dive on the nuclear industry, and I would encourage everyone to go take a look at it. The tagline here is AI-driven power demand set to spark a $350 billion build cycle. So despite some optimism or some skepticism you might have heard from Patricio and I, there's an alternative voice providing a little bit more sort of view on where that could head. So we'll try to get Scott on next week to walk us through the findings. And I know Patricio and actually others contributed, so you get a fuller picture of what that could look like. So join us next week for that. And Sally, I believe you've got a in-person event on Friday. You want to give a quick overview of what you're doing?
Yes, we have an oil market update. It's an in-person event here in the Bloomberg Dubai office. It's on Friday, 10 a.m. So I haven't looked through the attendees of this call, but if anyone is in Dubai, in the UAE, in the region, you are more than welcome to join us. Please do join us. If you want the details, the link to register, I can follow up and provide that for you. And very quickly as well, I don't know if you have anyone from Greece on the call today, but we will be with Will Harris. We will be in Athens next week, meeting some clients, and we will be doing an event in the Bloomberg Athens office next Tuesday as well. So if anyone is in town, wants the details, please get in touch with me over IB or email.
Fantastic. Yes, all of us are green dots on the terminal right now. So if you want to follow up on any of the events, shoot any one of us an IB. We'll get you pointed in the right direction. Or if you want to follow up with specific Q&A on any of the topics or any of our research generally, just reach out. We're happy to oblige. So again, we hold these calls every Wednesday at 10 a.m. New York time, and we hope to see you on the next one. Take care, everyone, and I hope you have a great rest of your week. Cheers.